I think transparency is really important in communication. Making sure we're updating our investors whether things go wrong or whether things, not just when things are going right. Things are slower than expected. To let them know what's happening in the market. There's a lot of people are worried about where the market is headed. Is it too hot? Interest rate changes. So just keeping them updated with educational material on that, I think, is important.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Brian Wagers is a multifamily investor. He grew his family's portfolio to 500 units before moving on to syndication, where he's now been involved in over $150 million worth of apartment transactions. Brian, welcome to the show.
Hey, thanks. Thanks, Sam. Good to be on here.
Hey, man, pleasure's mine. There's 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
Yeah, so I got started in Northwest Arkansas about 6 years ago. Bought a single family home, quickly diverted over to multifamily, had a 12 unit, scaled that into another 12 unit and a 20 unit combination of family money, seller financing, got my hands dirty with a medium-sized, small multifamily projects, built up a portfolio of about 450 to 500 units with just me as a lead sponsor, me as the only general partner, with friends and family. And just as of recently, partnered up with Elevate Commercial Investment Group, where now I'm a general partner on thousands of units.
That is really, really cool. I love that story of building a portfolio of 500 units. I'm really curious, once you had figured it out and once you had made it to that 500 unit mark, which is a lot of units, by the way. If you're just a single general partner in 500 units, that's a lot of units. What was the impetus for, joining another team and being a general partner with other people when you can really own 100% of your own deals right now?
Right. Yeah. So it was always in the back of my mind. I don't know that it was an aha moment. I think when I first got started in multifamily, the people that I was learning from, they were doing the syndications and they were doing the larger projects. But for me to get started, I really wanted to, have a track record, have somewhat of a proof of concept, get my hands dirty and do, all aspects of real estate. So I've always had multifamily syndications in the background of my head that's always thinking about different things. But I knew I was going to focus on multifamily. I was open to doing it different ways, So about 2 years ago, I was scaling my portfolio and I was starting to make offers on some of the same deals that I had seen before. They had come back full cycle. So I knew I was playing in a somewhat smaller space. So I knew that thought of going bigger was going to have to come soon. So I was really starting to plant some seeds with some other bigger time operators and looking at how I could provide value to them as I continue to grow. So yeah, I could keep, 100%, and keep trying to do the smaller deals. But I think for me, it was the inventory there, where I was coming across some of these deals, a couple of times. So that was kind of a good moment for me, knowing that I had to expand. And it was okay giving up, a portion of that in order to really grow. It's who, not how you get there. So I'm a firm believer in that, partnering up with strategic people to get you to continue to grow. And I'm always trying to be the best version of myself, in all aspects. So it's okay to relinquish some control in some areas. And, for me, that was partnering up and giving up some of that partnership.
I like that idea there, Brian, that, hey, I got to get out of my own backyard. I've got to go somewhere where somebody else has local market knowledge that you don't have to then rebuild. You have to get into a new market and say, all right, how do I figure out this market? You got somebody else that's experienced in it. I guess the question I would have, if someone is already in a market and they've already got people on the ground, they're already running a very large operation, what did you bring to the table, or how did you position it such that they would say to you, Brian, I'd love to have you be part of the team? what did that conversation look like? Not that you're not a great guy and you don't have great skills, because obviously you do, because you've taken down 500 units on your own. But even so, it seems like they would already have had all the seats in the bus taken care of.
Yeah. So for me, that was positioning myself to continue that track record. So it wasn't just, hey, I'm going to be a partner with your firm, like, let's go. It was a deal, work with them on a kind of a JV case by case basis. So it wasn't just, I was like, hey, give me an opportunity to prove myself. That's all I wanted, was an opportunity to, say I'm going to do what I say I'm going to do. So, that was raising on a couple of deals. So we raised on 3 or 4 deals before we actually, agreed on a partnership. And that was asking, for me, I focused on the capital raising piece. So that was going to be my focus. So when I was reaching out to other operators and seeing if, hey, is that something that you could bring on? And for the operators that I'm looking at high growth operators. So, the 2 main flows of multifamily real estate is, deals and equity. So that was my main, pivot point was, hey, where can I bring value? And that was in the equity piece.
Right. No, that's really cool. And again, I'm sorry for digging in maybe on this so much, but I think it's an important stepping stones for people who are in this business, looking to scale, looking to grow. They want to go, okay, how have other people done it? So focused on capital raise, why not just co-GP? What was the impetus? Again, I'm just trying to figure out. Again, not that you're not a good guy, but for the other, at Elevate, was it Elevate Equity? Was it
Elevate Commercial Investment Group?
Okay.
Yeah. So right. Like, so, and additionally to just co-GPing, it was, okay, what areas of their business did I find like bringing? I'm just, when I'm just co-GPing, I was just the capital, but
right.
Adding value outside of that during these other deals. So, jumping on calls, trying to add value as far as marketing goes, or trying to, help coordinate with other co-GPs that we may have on the deal, saying, okay, I'm going to commit to $1 million and I raise 1.2 million. That's great. That's a good track record, but going beyond, staying super organized throughout the whole deal, maybe giving recaps of what everybody's doing, try to find little value add pieces in each part of the deal. So going above and beyond, I think, was a main part there. And starting to I started to manage some of the other co-raisers before I was doing that, kind of staying ahead of our next steps. Hey, when do we need to get something on the calendar? Where are we at? So I think just over delivering on those, on that piece.
That's cool. No, I love that. That's absolutely awesome. Tell me, what, as you look at the portfolio, I guess, do you still own that 500 unit portfolio? Is that still yours?
So it dwindled down to around like 250, 300 units. We're selling. So we just sold 102 units today. I sold 54 units earlier this year. We did sell 82 units, but we bought 72 more at the end of last year. So, it's right around, 250, 300, but we're looking at selling a lot of that, a lot of my personal portfolio.
Is that because it's just, the market is just red hot and you can just get top dollar for it? Is that kind of your thinking there? Or was there other things that are driving those decisions?
Yeah, there's several different factors, but that being, one of the main reasons, the market is super hot, where, more and more people are looking at our market of Northwest Arkansas. Mm-hmm. 2, we've implemented a lot of the value add business plan. Some of these deals we've only held for 2 years, 3 years, but, we've got it to about where we want to be. And if we can get those offers that we expected to have in 5 years and 2 years, then might as well, especially with me focusing on, these larger deals. It just gives me more equity to put back alongside of on these larger deals. So it's a huge plus having that. I built up quite a bit of equity in these smaller deals to, place in the larger deals.
Yeah, that's a great point, is that you can recycle that back into your own opportunities and, develop more of the limited partner side of things, as you invest in your own opportunities than you could maybe on the active investor side.
Yeah. Yeah. So I'm investing as a LP in all our deals too, as well as, helping on the GP portion.
Right. Oh, that's cool. And that certainly gives your investors a vote of confidence as well.
Yeah, it's definitely, an extra, there's a lot of reassurances in multifamily, but I think, being able to invest alongside your investors is super important to them. But I wasn't always able to do that. I had to, that's, one of the reasons I had to do those small and medium-sized deals was to really help, one, get my track record and prove the concept, like I mentioned before, but, get that equity to be able to invest with them.
Yeah, no, I think that's awesome. What are some challenges that you see in the capital raising space right now?
I think transparency is really important, and communication, making sure we're updating our investors, whether things go wrong or whether things, not just when things are going right, things are slower than expected, to let them know what's happening in the market. There's a lot of people are worried about where the market is headed. Is it too hot? Interest rate changes. So just keeping them updated with educational material on that, I think, is important. Making sure you explain your underwriting. I think investors are getting more and more sophisticated. So, it's important to show them your underwriting, your assumptions, and make it clear on what the risks are and what the potential are.
Yeah, absolutely. Let's talk about that. If we're standing on shaky ground, or everybody's been calling for a recession for, Lord, who knows how many years, 5, 7 years. But I mean, even so, there are some things changing. We continue, especially in the multifamily market, to see cap rates compress, and now we're seeing rates go up. What are you guys doing in this environment to remain competitive?
Yeah, so underwriting more deals is the big thing. Getting in front of more deals, bringing on more boots on the ground partners that can find us deals that are local. I'm finding more and more important that people local in the market are sometimes getting first looks at deals. So sometimes we'll bring on partners who find deals in their local market, have relationships with commercial brokers. And as far as the cap rates, you want to make sure you're underwriting for higher cap rates. That's huge. And the interest rate changes, refinance events in year 3, we definitely want to make sure we're not in the same interest rate or a lower interest rate at what we're coming in at. So we're making sure that that interest rate is going up at year 3. And we're also accounting for a higher cap rate at sale in year 5.
Yeah, no, that's absolutely important. What do you think? This is pure, just subjective questioning. We've seen rent rates, and I own some multifamily properties, and we've just seen rents just up and to the right. All of us have. What are you guys doing on your underwriting side for rent growth, if any?
Yeah, we're keeping it around 2%. We try to keep it around 2% annually, 3%, depending on the location, depending on the asset class. That can vary from C class to A class. So we are looking more and more at A class. The way with cap rates compressing, we have started to look more and more at the A class opportunities. Now 5 years ago, I would tell you, I'll never buy an A class. I'm a value add, C class to B class property buyer. But the way the market is, we're starting to shift that outlook as far as with the way the cap rates are going. But, definitely if it's a deep value add, obviously we can increase those rents quite a bit more than just a 2%, 3%. But once upon stabilization, we're looking around 2% rent growth.
Gotcha. No, that's really interesting. You say you're moving into A class. Can you give me some really insight into why you're finding more value or even potentially less risk in an A class asset?
Yeah. So the A class stuff that we're looking at, one, if you think about A class in general, you kind of think less headaches. It's a more appealing investment to more institutional equity that we are getting more and more of. They see it as a more safe bet, whereas the way that the housing market is going. It's becoming harder and harder to buy a house. And so for young professionals to really fork up to buy a $400,000, $500,000 house, they may see it better to ride it out and live in a nice A-class community with good amenities for a while before they can move into a permanent home. So, the factors, the way the single family market is, less maintenance on the front end, so you can underwrite for that, and more of a safe, longer ride, for some of our people who are wanting to hold closer to the 5-year term.
Got it. No, that makes a lot of sense. Yeah, offsetting some of that risk by buying newer, nicer assets. Maybe you don't have the maintenance, but also, like you said, is that your institutional players tend to like that space. So if you guys are looking for an exit in 3 to 5 years, your buyer pool probably exists at a much larger buyer pool on those types of assets.
Yeah, exactly. Right. Yeah. So you're always looking at what your exit plan is and who you're going to ultimately sell it to. So now we have a lot more capital chasing, multifamily real estate. A lot of these people in COVID that were buying office space and retail space are now looking at multifamily. A lot of these people that have their money in the stocks and the money in, other vehicles are more and more looking at, the real estate market. So I think that also helped offset some of those interest rates we're seeing. It's becoming a more liquid space, because like you said, you have a lot more exit buyers for your properties.
Right. No, that's really cool. How do you overcome, I would think, though, as you move into the A-class space, that your return profile just, gets diminished? I mean, is that a fair assumption?
Yeah, it's definitely fair. You're the A-class developers, builders, they are looking for premiums. Really have to find, it's like, if it's an A-class, you have to find the value that you can add. So, hopefully we are, when we're buying A-class, we're trying to buy from the developers. So they've got it to 90% lease up. And they're just getting it leased up however they can. So they're offering concessions. They may be putting a little bit higher expenses in. They just want to get that property leased up. So we're then able to get some of those expenses down a little bit, and start pushing the rents up to more market rents versus to the rents that they were, just to get people in the door to where they can eventually exit. So finding that value in that space is really important, because not every A-class is an opportunity, but we definitely like to buy from the developers for that reason.
Right. No, that's an interesting strategy, and not one I hear a lot about, but I think it has a lot of merit in that, like you said, you can improve their operations, decrease expenses, bring rents up to market. And yeah, at the same time, you're not having the risk of being the developer getting the project done. So it's kind of like it's a nice hybrid approach to development in its own right.
Exactly. You just have to be upfront with your investors. And if they're buying into an opportunity like that, the cash flow is going to be low, especially on the front end. But right. That's what you get when you are buying those kind of opportunities. Right.
And as long as everybody understands the rules of the game, then that is what it is. So I think that's really, really cool. Brian, thank you for taking the time to jump on today and really tell us, the nuances of transitioning from owning 500 of your own units to then just joining a team. It's kind of like that idea of McDonald's. It's like, do you want to own 100% of your own deal or 1% of McDonald's? Well, I'll take 1% of McDonald's all day long. So I love the idea for you, joining a bigger team and just owning a smaller piece of a bigger pie. I think that's really, really cool, and love just how you've brought value to that team and shared the way that you've done that in order to, make this all work. So thanks again, for sharing your insight today. Do appreciate it. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Yeah, you can email me, brian@elevatecig.com. I'm on Facebook, Instagram, LinkedIn. Message me on one of those if you're active in the space too. Just Brian Wagers.
Awesome, Brian. We'll be sure to include that all in the show notes. And certainly thank you again for coming on.
Yeah, absolutely, Sam. Thanks for having me. Sorry about the background noise today.
Hey, man, no sweat at all. Appreciate it.